Okay, looks like we're starting to move towards a full house, over 75 of you at the moment, so that's great. So my name is Kevin Uphill. I'm the chairman of Avondale Corporate. I'm also an entrepreneur and business published author, having got three books behind my name. Today we are going to concentrate on valuations and hopefully a great webinar giving you some really good technical tips on how companies are valued today. Been a great weekend for sport, so let's see if we can do a great webinar. The first question that seems to be on everyone's lips when they phone us today is around Brexit and how Brexit is going to impact on deal valuations. What is going to happen to mergers and acquisitions in the Brexit market? We are reasonably optimistic. Brexit, we've had a long time to talk about it. The result, I think, was broadly unexpected. And the view that we seem to be taking at the moment, based on early activity, is that it will be broadly business as usual. Our pipeline in terms of transactions has held, which is great. We have had a few banks wanting to review some of their credit terms, which is to be expected, as the broad economic forecast is a slight slowdown in economic activity with a possibility of recession. The last crash in 2008, 2009, I don't know if you guys remember it, was pretty scary. The UK GDP, that's UK turnover, dropped by 5%. This year we've got 1.5% growth already. So our feeling is that whilst we might experience a fairly significant slowdown in the economy, it will not have a dramatic impact on mergers and acquisitions, so long as the credit supply continues as far as the banks are concerned. But even that, we're not unduly concerned. International money is still interested in the UK. We've got two transactions, one with Italian and one with Spanish at the moment. Also looking at one in Hong Kong, and all have held the course so far. I suppose the underlying element in terms of transactions and valuations, will deal structures change? Will valuations change? And the biggest reason that we're fairly optimistic is there's still over £2 billion worth of private equity money in the UK looking for a home in terms of doing transactions and deals. If you take a look at why, simply put, there's no yield in terms of investments. The FTSE is quite difficult. We've bounced back since the Brexit, which is encouraging, but actually generating a long-term yield from stock market is proving challenging. The property market, I think we could all forecast a fairly material slowdown, if not a decline. And as a consequence of that, people are looking at the mid-tier market in order to try and get a yield. The private equity is very, very interested in the mid-tier market. Currently, we've got over 35% of our transactions with private equity, 20% international, and the other 50% trade. So our view is that deals will continue to happen. And in a slow growth environment, M&A is an essential activity to creating shareholder value and organisational restructuring. If you think about it, if you've got businesses that have got fast growth, organic growth, they actually have less time to look at acquisition and less motivation. But in a slow growth environment, it underpins the need to look at corporate restructuring and mergers and acquisitions work. So we believe that that will help underpin the valuation side of businesses. In other words, we shouldn't see too much of a change in the way companies are valued. So we need to look, as this is a technical seminar, at how valuations are actually calculated and give some steers on some of the things we're actually seeing occurring in those valuations. In order to really look at that, you've got this underlying trend of slow growth in the developed world fueling the way people are looking at acquisitions. And this graph shows that point I suggested earlier about how in 2008, 2009 we had a big dip in UK GDP, and you can see that broadly we're experiencing a flat line. I think Brexit is adding to that flat line, but not necessarily detracting from that line. So the underlying element of deals is, sorry, technical problem with the slides here. Oh, there we go. So the underlying element of deals, we're seeing sellers. We've got a lot of sellers who are looking to cash in simply because family succession isn't something that works for them. MBOs are reduced because leverage buyouts and funding is not so easily available. Buyers, organic growth is slow, so the underpinning is looking at shareholder value in order to create growth. And international buyers in order to create access to new markets. Interestingly, one of the international buyers we're dealing with at the moment in Poland, in the haulage sector, a lot of trucks coming over here, looking to fill those trucks going back. So those underlying strategic reasons to do deals still occur. And from that perspective, we're therefore happy that the valuation methods will broadly remain the same, despite the Brexit, if you like, uncertainty. So how are companies valued and what's the method of valuation today? Most of you guys would have heard about private equity, price earnings ratios as a valuation method. And typically in the small to mid market, which is where we operate, typically the 700,000 deal value up to say 50 million, price earnings ratios is the main method of valuation. That's a multiple of the profits in a business on a sustainable basis, and that's actually critical. More and more people are looking at the sustainable adjusted profits. So we're not so interested in what happened 3 years ago. It's what happened this year, what's happening next year, and the year after, and the recurring revenue stream behind that. So the companies that we're seeing that have high multiples of profit have more forecastability in their income flow. So to give you a bit of a hint on that, if you can imagine, for example, an estate agent, well, you're only as good as the property market, and also it's how good are your team at winning instructions in the local patch this year. Whereas a lettings agent, very strong recurring revenue, would tend to go therefore for higher multiples than the estate agent. Same sector, but different product and service. One with much higher visibility on the earnings multiple. So most valuations in the small and mid-market are done on a price earnings ratio, but also we're looking at that being a multiple of those adjusted profits. And the adjustments are normally around the owner-manager team. So the way in which they've been operating, we're acting on a sale at the moment where the owner's over in Switzerland, £300,000 or £400,000 a year is going out in owner expenses, but he's not hands-on in the business at all. That's known as an add back. So we can adjust that and use the adjusted profit as a base for the valuation. Valuations are only a forecast. We take all our projects to market on an offers basis. The market decides. We recently had a project where we've seen valuations ranging from 2.5 million up to 5 million. So that gives you a really good indication that a valuation as a business value is only ever giving a forecast. And it's actually only on the day of completion you know whether you've got that valuation correct or accurate. And of course after that it changes again. Most valuations, price earnings multiple of profit, adjusted, typically debt-free cash flow. That basically means that we're adjusting the balance sheet as well to get the valuation. But before we look at debt-free, cash-free, and we look at those adjustments, let's sort of summarize it, if you like, in this, this slide. This shows you what we call multiples of profit. If you look down the left-hand side, you've got 0 to 12. So the small to mid-market on a pre-tax basis typically is a multiple of profit between 0 and 12. Most deals are 3 to 8. And then the two outsides of the extremity. And if you look at the profit lines above, you've got adjusted profit, that's adjusted for the owner's costs, but you've also got EBITDA or PBIT profit. EBITDA is earnings before interest, tax, depreciation and amortization. PBIT, profits before interest and tax. Now we tend to find EBITDA is used for service companies, PBIT is used for high capex companies. So something like a manufacturing business or a haulage firm would tend to be PBIT. A service business, something like the lettings agent I was talking about earlier, would tend to be an EBITDA profit. Both adjusted for the owner's costs. The dark band is the sort of most likely or accountancy valuation. The gold band is where we call it aspirational value, where you're starting to get punchier multiples and where the deal value is looking better. You can see that the bigger the profits as you go across the top horizontal line, the higher the multiple when you're looking at the valuation of a company. Why is that? Well, quite simply, the bigger the profits, usually the bigger the infrastructure, therefore the more sustainable the business, the more forecastable the cash flow, and potentially the more economies of scale. But also, the bigger the profits, the more likely we are to get a higher level corporate buyer themselves trading at a higher multiple. So they only tend to want to buy bigger companies and they are themselves more comfortable with higher multiples. So the bigger the profits, the bigger the multiple. Now the key for you alchemists out there is there's an opportunity if you're thinking of buying companies. If you can buy 3 or 4 companies at say a multiple of 4 to 5 times profit in the 300 to 500k profit range, bolt them together, get economies of scale, get some synergy between the businesses and then sell it on, maybe with a combined profit 2 to 3 million, then you push the multiple up on exit. And fundamentally, it's that model that most of our private equity buyers are looking to enact. Pulling together at lower multiples, consolidating and exiting at higher multiples with the combination of organic growth and buy and build strategy. So it's quite an interesting area, and one of the top tips to preparing a company for sale is to also therefore look at acquisitions as part of that equation. So the bigger the profits, the bigger the multiple, but the other element that most impacts on multiple is the recurring forecastability of the business. So one of the things that we really ask people to look at when they're preparing for sale, whether it's a year out or 4 years out, is to look at the recurring revenue that they are generating in the business and not just flat. So you'll have seen many a prospectus where you describe the top 20, top 30 clients in the last year. I want to know what the top 30 client spend has been over the last 5 years and to model that. That is the heart of the goodwill in a business. And it's that recurring revenue that people are paying for, whether it's contracted or otherwise, because it's tomorrow's profits they're looking to buy. So, bigger multiples on bigger profits and generally higher quality, more recurring revenue. EBITDA for service businesses, that means we can add back depreciation and amortization, interest, PBIT, CapEx and capital expenditure. Depreciation is a real cost. So on high extensive capital businesses such as manufacturing, PBIT tends to be used. This is great in theory, but let's just try and translate it into some real numbers. Sorry, slides again, technology. So I've got an example here of a medical clinic that we enacted on in the last year. So it's the business we sold. I mentioned earlier most valuations are a multiple of profit, but I also mentioned they are using a balance sheet on a debt-free, cash-free basis. Because of Entrepreneurs Relief in the UK, most of the deals we do are share transfers, because that's how you qualify for it. You need to have more than 5%, and you need to have owned the shares for a year to qualify for it. But up to 10 million, you only pay capital gains tax at 10% per executive shareholder. So most of the deals are share transfers, and that means the balance sheet goes with the deal. But clearly, if you look at the multiple page earlier, a business with a very strong balance sheet, perhaps with surplus cash or freehold, should go for a higher price than one that's highly geared with a low, weak balance sheet. So debt-free, cash-free gives us a method of trying to analyse the surplus capital in a balance sheet. And the sort of multiples and values we were quoting earlier assumed that we've adjusted for that balance sheet. So if you've got a very strong balance sheet, we would expect, say, the multiple of 5 or 6 times plus the surplus cash. A debt-free cash free is a method of calculating that enables you to work that out. It's different for every company because the other element, it also depends on what's known as normalized working capital, and we spend forever navigating this when we're negotiating deals. That's variable depending on seasonality in businesses and areas around the cost base of the business. But debt-free cash free is effectively taking the cash and netting out the inland revenue, HP, finance costs, any director's loans. And if there's a surplus, then it's typically added to the deal. If there's a negative, then it's deducted from the deal. So the multiple is typically on a debt-free, cash-free basis, and the price may be higher or lower depending on the calculation here. Of course, fundamentally, when people talk about multiples and in the generic press, you can't therefore quantify whether the valuation is a high or a low multiple, because until you know what level of balance sheet went with the deal, it's very difficult to look at the goodwill that was actually paid. Because the accounting definition of goodwill is the difference between the price paid and the net asset value. So clearly, a bigger multiple you would expect to sell with a lean balance sheet if you can. This medical clinic, we did debt-free, cash-free. They'd bought a lot of equipment, and actually they were in a slight negative. So whilst we used a multiple, we actually adjusted that price when we did our valuation. Let's look at how that turned into real numbers. So we had a small business here with a turnover of 2.3 million, operating profit of 438,000. For various historic reasons, the rent was being undercharged, so we needed to change the way the rent was adjusted. They'd had historically a manager in there, a general manager running the clinic, but they had proved in the last 6-7 months that they didn't need them, and the business was operating without them. Having said that, one of the directors was also taking quite a significant salary, so we adjusted 150,000 for them because they weren't involved in the business day in, day out. So you can see we take the operating profit and we remodel that around various different costs. Because this was a high capital intensive business, we used a PBIT or EBIT. Depreciation is a real cost. They also had some historic factoring, so we adjusted that. So we got to a historic adjusted profit, a PBIT of 520,000, and we believe medical clinic, on our own experience, it would probably go for a multiple of around 5.5. So we gave them a financial forecast of 2.86 million. Remember, this is debt-free, cash-free, so we then actually took 25 grand off that. So it gives you the idea of where we thought the value would be. But we actually marketed the business on an offers basis. We got 2 bids, and that took us to 4 million on exit. So another key element when you're looking at valuations is actually looking at the deal structure. So people who say, oh, well, it should be a 5 or 6 times multiple, that's how you value companies. It's too singular because deal structure has a significant bearing on the way people see multiples. We've talked earlier, sustainable revenue means lower risk, which means a higher multiple can be paid. But the other element that can influence multiple is deal structure. If you are having to pay all the money up front, then that's high risk, particularly if the owners are not going to stay and help you run the business and ensure that you've got a good handover. So that might push the multiple down. If, however, you are able to defer some of the money, get the sellers to join you on a journey of waiting for some of that money through either a deferred payment or an earn-out, then you may be in a position where you can pay a slightly higher multiple because you've de-risked the transaction. So deal structure has a significant bearing on multiple when you're looking at valuations. So back to, a valuation is only ever a financial forecast and is only the day of completion, and when we know the deal structure, can we really comment on whether that was a good deal or a bad deal from a valuation point of view. So looking at this medical clinic, we actually got £2 million on completion, a £1 million vendor loan note. That was paid over 3 years on a deferred basis. There was no interest because we got a high price, although most loan notes have interest. So that was basically the sellers saying, we are prepared to wait for some of the money, and helping the buyer, which was a large corporate trade buyer. They had 25 other clinics. They were also private equity backed, do the transaction. So assisting, if you like, with the cost of finance. So it's really a £3 million deal as far as certainty of money, 2 million in cash, $1 million deferred, lots of guarantees and protections in to help that million be secured. But we also then had an earn out on growth. Our modelling on the business showed that their underlying profit run rate, if we looked on a monthly basis, should hit the 600,000 to 700,000 range by this time next year. So we actually did the structure of the deal based on them achieving a £750,000 profit rate rather than a 550k profit rate. And that's where the extra million came from. So over 3 years, the two doctors involved in this business are having to work, stay involved, hand the business over, run it for the owners, one of them part-time, the other full-time, and drive the business to achieve that 550,000 profit to 750 profit. And if they do that, they'll get the extra £1 million earn out. Now the bad news here is tax, because if you want to get your entrepreneur's relief, what you need to do is say to the inland revenue, we are going to pay our tax based on the 4 million, and if we don't get it, we then have to claim it back. So from a cash flow point of view, in terms of taxation, this is not great for sellers. But 4 million is better than the forecast 2.8 million that we've put forward. So overall, a very, very good deal, which shows you how deal structure can influence valuations as much as the valuation itself and the formula behind the valuation. So if we look further forward, we also can see that point about a strategic transaction impacting on valuations. Companies are worth different things to different buyers. We're currently acting at the moment on a transaction where the trade buyers, surprisingly, have actually come in lower than a bought-in management buyout team. And the reason for that is a lot of people in our sector talk about trade companies being the best people to buy a business, and that certainly is true. And the reason behind that is that they get the economies of scale and the synergy straight off. So it normally is true. But there's one downside to that argument. If you think about it, for example, your competition, if they're looking at buying you, they've always got the choice of organic growth. So sometimes the higher value transactions occur when someone's slightly off-piste or left of centre. So they're kind of in the sector, they understand it, but they're not doing it. And that's what we call a strategic deal, a strategic buyer. So valuations, there's not just a calculation, there's also the process of how you go about realising that deal and that deal value. Whether it's preparing up front, positioning the business in the right way when you take it to the market, finding the right strategic buyers, or having a lead advisor that structures the deal to realise the underlying value within the business. So an 8 times multiple there, which if we go back to your chart, which we've seen earlier, and we will be sending these slides out, is much higher than the original forecast of the 5.5 multiple that we put forward. And we see that time and time again. Multiples vary depending on how the process is run. So valuations are a financial exercise, and they are very dependent on a modelling basis. And we very often have lots of debate with accountants, particularly over should we use the last 3 years' historic profits. And I think the good news is the market has moved on from that thinking. Yes, the past is a guide to the future, and it does have a bearing on valuations. But more important are the forecasts. The past has already been spent. The future is to be enjoyed. That is what we're buying. So again, if you're looking to sell a company and you're looking to influence value, being able to demonstrate on a recurring basis how your forecasts are improving month on month is actually critical to getting a higher valuation and that valuation calculation. So here are some examples of some deals we've done recently and seen recently. My favourite at the bottom there, I haven't got time to run through them all, but the Updata transaction, a guy called Richard sold 25% of that. He used to go to the same school as me, and what was great about this story, you can see he got a significant sum of money and a very strong multiple. It was bought by Capita. The reason they got such a high multiple was it was all contracted recurring revenue, very, very large contracts in the fibre optic broadband space, and so very, very, very strong forecasted revenue stream. What's really good about the story, though, he got his significant sum of money, and the old school trust phoned him up and said, look, we hear you've done rather well, sir. He heard them out for 5 minutes. We'd like to raise some money for our school. And he turned around and said, you do realise you expelled me, don't you? Which points out that it's all about entrepreneurs, and that's certainly a part of our ethos at Avondale in recognising that. So whilst here today I'm talking to you about valuations and the way in which valuations work, I'm also very interested in, and the practice is very interested in, that entrepreneur journey with business owners. So some of you may be looking at this going, A, that's quite technical. Did we follow it all? B, I'm happy with my valuation. And C, I'm not happy with my valuation. First things first, we are very happy if you want to talk to us and get more of a feel to where you actually are, to look at accounts and give you a broad brush approach without cost. So do pick the phone up, do send in accounts. That is helpful. We think getting a valuation every year or so is really useful for boards and board strategies in understanding how to maximise their position when looking at this process. I'm talking mainly from the exit perspective, but of course the same for acquirers. If you're looking at targets, we've got 2 projects at the moment where we're assisting people buying companies and just doing the negotiation to get the deal structure right. But the other thing that I would urge you to look at, yes, I've given you some models, earnings, EBITDA, PBIT, multiple of profit, debt-free, cash-free. But the other question is, how much can you influence your multiple in your strategy? And so one of the really good questions I like to ask business owners and boards, how much time have you actually spent in your meetings, and I mean your board strategy meetings, looking at how you are influencing value? Because very often when we hold the mirror up to business owners in our strategy practice, the question is very limited. Most of the time is spent on management, looking at who's good at what within the organisation, what's working well, what isn't, as opposed to how are we strategically influencing our multiple? How are we increasing the recurring sustainable nature of our business model in a way that a buyer will look at that and put a higher premium on it when we exit? Okay, so I hope that's been a useful whirlwind tour of how valuations are calculated, and it is a technical subject. Very happy to take some questions now.
The first question is, how far in advance would you recommend starting a business sale process?
Well, that's a good one. Depends what you call business sale process. You just heard me there talking about managing the multiple. I fundamentally believe, and certainly the business entrepreneurs that we see that are successful in this space, they think about who the buyer is, how they can get the best recurring revenue from the start. It's not all about volume. It's not all about turnover. It's about margin. It's about recurring revenue and quality in that margin. And that question should be asked right from the start of actually starting a business. So 5, 10 years out, longer.
The next one we have is, what areas in my business should I start looking at first with a view of increasing my value?
Okay, that's actually quite a difficult one, because That's different for everybody. I'm going to throw a challenge out to you business owners and entrepreneurs out there listening today. I would suggest it's the bits you don't like. It's the bits you don't enjoy doing. What you enjoy doing tends to work well. If you are a great marketeer and salesperson, then probably it's your process, it's your systems and organisation that need looking at. If you're great at process and systems, probably it's your marketing and sales that need looking at. But actually the other thing is to look at yourself. You know, it's very easy to talk about how you can build more recurring revenue, how we can win more projects, how we can win more customers. But the real key to building value in the businesses is leadership as opposed to management. By that I mean it's looking at where you spend your time on a hands-off basis improving the strategy of the business. So holding the mirror up and saying, what are my bad habits? Where am I good? And as a consequence, where is the business doing well and where is it suffering? But also, where do I really spend my time? How much am I helping people answer questions they already employed to answer? As opposed to looking at these sort of questions, how do we influence a multiple? How do we increase the value?
And the last question we have is, I have someone looking to buy my business at the moment. What is the benefit of involving an advisor at this stage?
We're really clear on that. Advisors, you know, yes, there's a cost involved, but at the end of the day, it's very technical, even down to deal structure, protecting those deal structures, making sure that if there's an earn-out or a deferred payment, that it's not just on paper, it's actually achieved. Making sure the transaction is a win-win, making sure that you are in a position where the deal that's agreed in the first instance is the one that goes across the line at the end. That's not just technical in terms of advisory. How do we protect the terms? How do we make sure the terms are achievable? How do we make sure that we've got the right players in place to actually get the project across the line? So it's advisory, it's project management, it's technical, it's guiding you, and in a way that enables you to concentrate on growing and running the business. Too many people, M&A is a complicated process. They take their eye off the ball as a consequence of the process. The business is damaged, and then they find out they lose a transaction. If you delegate that to the right professional with the right expertise that understands your vision and ambition, the costs involved will be far offset by the gain either in value or deal structure or increased likelihood of completion. Thank you all for listening. Thank you.